Okay, so we're continuing chapter 13, and now we're on the part about contingencies. Okay, so what's a contingency? You make a bet that the Red Sox will win on opening day. And whether you get your money or not is contingent. It depends on whether they win or not. You talk about planning for different contingencies. You know, you're planning for something, you're not sure if it's going to happen, but it's something in the future. Well, in accounting, a contingent liability is one where there's an existing condition or set of circumstances that involves uncertainty, and there may be a possible gain or loss, and it won't be resolved until something in the future happens. So basically, as of the balance sheet date, an event has happened. Maybe someone has slipped on the banana peel in your store, they've been injured, they've gone off in the ambulance. Chances are you're going to have to pay out some medical expenses there. You don't know how much, you don't know for sure if you will, but it's a contingency that you may have to account for. Gain contingencies, we have gain and loss contingencies. I call gain contingencies the happy contingencies, and they're happy for two reasons. One is that the company may receive something in the future. The other is that there's absolutely no accounting for them. We don't have to do journal entries. So gain contingencies, you may receive something in the future. You may get cash from a lawsuit that comes out in your favor. Tax carry forwards are the most frequent gain contingency. And these gain contingencies are disclosed in the notes, but only if the company or the entity is very likely to receive something. Okay, so gain contingencies, they're the happy ones. Okay, so then we have loss contingencies. Okay, so let's talk a little bit about loss contingencies. There's 4 different loss contingencies that will be covered. The litigation, warranties, premiums, and environmental, basically your asset retirement obligations. Oops, next. Okay. And before we go on to all of those, you have to know the basic principle. If something is probable, a future event is likely to happen, and you can estimate the amount, then it will be booked, recorded as a contingent liability on your books. Even though it hasn't happened yet, you're not positive it'll happen, but it is probable it'll happen. The other 2 categories are reasonably possible. It's more than remote, but less than likely. We don't necessarily record, we don't record those. We don't make adjusting entries for those. They may be disclosed in the notes to the financial statements. Remote, the chance of the future event is remote. You can see there's a lot of judgment calls here, and this whole area is really open to a lot of abuse. Okay, so the basic thing, if it's probable that we incurred a liability, you don't need to know the exact amount, you don't need to know exactly who you're paying it to, but you know you're probably going to have to pay something, and you can estimate it, and it's usually based on legal advice. Okay, so the book gives examples of all of these. I've got some of those examples here, and I categorize them a little bit differently than they do. These examples are the ones that are probable, and you already have some loss contingencies you know and love. The allowance for uncollectible accounts related to your bad debt expense. Yeah, we don't know how many customers won't pay, but we know that we can estimate that, so we record them. Warranties and premiums we'll get to later in this chapter. Now, there's a bunch of other things that the book says may be accrued, and so I'm just putting them in that sort of, I just hate to get too many confusing categories, so I try to stick with the same thing. These are examples of things that are reasonably possible, and if they rise to the level of probable, then you would record them. Otherwise, you might just disclose them in the notes. So these are things the government might expropriate assets. So maybe there's a rumor flying around, but so then it's not recorded as a contingent liability, but when they actually start making moves, well, then you might record it on the books. Pending litigation, the same thing, and they give you a whole bunch of possible claims and assessments that If they're probable, you're going to book them. If they don't rise to that level, you don't. Okay, and then things that are generally not accrued as liabilities, contingent liabilities, general business risks. You know, your building could catch fire. There could be a hurricane. Yeah, okay, so risks related to fire, explosions, and other hazards, okay? Risks that are covered by insurance. Someone might do a lawsuit, but, you know, it's sort of an unasserted thing. And so these are generally not accrued as a liability if it's remote. And they don't have to disclose them if they're remote. Okay, so those are your basic parameters of loss contingencies. And so now we'll look at the various categories, the litigation, warranties, premiums, and all of that.